Good evening, everyone. Welcome to our Georgia Tech Alumni Homebuyer Workshop. My name is Jason Maida. Great to be with all of you this evening. I know we're going to be all start kind of filing into the Zoom session, so I'll let you get situated here. Really excited to have our first class for 2026 for the alumni. Those of you that have heard about our class, this is a workshop that we teach on a quarterly basis. It's obviously a free class, and we encourage you to participate in our class by asking questions. You can use the chat feature or Q&A within Zoom. I'll be kind of monitoring both of those windows, and then we'll answer those questions on air. We'll also carve out some time in the latter part of tonight's class to maybe catch up on something that didn't get touched on during class, but ultimately want to make sure you guys give you all the tools and resources you have as you're kind of starting this journey of thinking about home ownership. So what we'll do is we'll go through tonight's class. It'll be very interactive. We have some key concepts that we're going to kind of deliver to you tonight, and just love to kind of be able to kind of have some conversation with you around home buying. Well, my name is Jason Maida. So again, I'm going to be your host this evening, presenter. My colleague Ken Fleck and I will be answering those questions that come up in the chat and Q&A. We work for an organization called APM, or American Pacific Mortgage. We're the 9th largest lender in the country. We span all across the United States. Our team specifically is focused in on local educational community in homeownership. And so we want to make sure that we provide you tools and resources as you're deciding to make this major financial decision in your lives. We touch on things like assistance programs in classes like this, touch on, obviously, you're going to learn about credit and whatnot, but ultimately this is a learning environment for you to really help understand more about homeownership. We are recording tonight's class. So tonight's class will be up on our YouTube channel tomorrow. So if you have to step away from your computer, or if you want to just kind of pass along the link from tonight's class, we'd encourage you to share that with friends, family, and coworkers. We'll have 3 other classes available in 2026 that'll be available to you if you decide you want to do kind of a refresh on the content from today. Tonight we're going to talk a little bit about the housing market, what's happening there, spend some time talking also about interest rates, a lot of kind of activity in the interest rate world, and kind of what we're seeing as we're kind of really in the middle of the February buying season, which is obviously usually, I should say, slower times. But we're going to talk more about kind of what's happening housing wise. We'll walk you through a rent versus buying calculator tonight to take a look at comparing renting versus what buying and what it could look like for you. Spend some time also looking about credit and maybe give you some tips and some tricks around credit to help maybe improve your credit score, especially as you're getting ready to start with home ownership. And I had some pop in. Are we okay on the audio? Can you guys hear us okay? Somebody in the chat just mentioned they couldn't hear us. Can you guys hear us okay? I got a hand raised. Maybe that means we're okay. Yes, we're good. Okay. All right. So maybe, yeah, I got some yeses in there. So maybe you're having some audio issues there. And again, I'm recording the class, so if you missed something I've covered and you haven't picked it up because your audio situation, we'll make sure you'll be able to look back on that. So again, we're going to look at rent versus buying calculators and kind of just do a quick comparison on renting versus buying. We're also going to look at loan programs. Some of the terminology that you've probably heard around home ownership, I want to kind of put the pieces to the puzzle together. Talk a little bit about how we build up reserves or savings for home ownership, and then we'll transition to first-time home buyer programs. Speaking of that, if you can, we have a pretty good sized class tonight. If you don't mind dropping in the chat where you think you want to buy, why that's helpful for me is because when we talk about first-time home buyer programs, there are some state-specific programs, and we might be able to kind of dive into a few of the details of that. So if you're comfortable putting where you're thinking about buying, just drop that in the chat. That'll kind of help me in kind of targeting some of those first-time buyer programs. We're also going to talk about the buying process. That's one of our topics later on in tonight's class. That's probably one of the most important elements of tonight's class. It's really like where you go from the classroom setting like this to what does the buying process look like for you as a potential home buyer. So I'm going to walk you through the 6 steps of home buying, and then we'll kind of just tie everything together with like what do the next steps look like for you as a buyer, and how maybe you can get connected with me for a free buyer's consultation just to learn a little bit more about your options around home ownership. All right? Okay, so that's our plan for tonight. Our run time will take us up just to about the top of the hour, but I will stick around as long as you guys need me to be here to help facilitate any question and answering for you, okay? All right, well, let's talk a little bit about buying, and really doesn't make sense for me as a prospective home buyer. This, again, is probably going to be one of the largest financial decisions you decide to make here at some point in time. I think as you're considering home ownership, I would encourage you to think about some of the benefits that can come along with home ownership. So when we look at our budget, for example, in renting, right, we're kind of stuck with what the landlord charges us for our rent, and then they're probably going to escalate that payment on an annual basis. But when you're a homeowner, you have more kind of a control of what your budget looks like because ultimately you paid a certain amount for the price of the home, you finance a certain amount, so you really know what your payment's going to be. And for most first-time buyers, that's span over 30 years. So you really have a good idea of like how I can budget myself, right? Now, clients that are buying in today's market, even though interest rates still remain kind of at elevated levels, they are going to have an opportunity to refinance at some point in time and help to decrease that amount of monthly payment. Now, this is an asset, and for most of us that are current homeowners, it's our number one asset. It, grows over time. Sometimes it grows in equity more or at higher rates than others in certain years. But ultimately, if I buy my house at a certain price point, that home goes up in value, and then I start paying down my mortgage over the course of say 30 years. The difference between what the market value says is my home versus what my balance is, that's home equity. And for most of us, again, that is our number one asset that we have, maybe aside from retirement accounts or whatnot. And it does have the opportunity to create generational wealth for many of us that do take on homeownership. Another great benefit with homeownership is there's tax benefits with homeownership. You can potentially deduct interest on your mortgage. And for some homeowners that decide to make energy efficient upgrades, that can also lead to more tax benefits. So when I think about my budget for homeownership versus, what I'm paying in rent, I have to really factor in all those key elements of ownership when I compare my monthly budget because it's not fair to call it like an apples to apples comparison with those two budgets because you're having all these great benefits that make up home ownership. Now, to help us kind of highlight what that looks like, what I thought I would do is kind of walk you guys through a rent versus buying calculator. It's one of the many tools that we offer our first-time buyers, and we provide it as part of our consultations, but we were also going to include the link in tonight's presentation. You can see here as I kind of switch up the screen share here, this is a look at some of our calculators I think are pretty helpful for existing homeowners as well as future buyers. But I'm going to walk you through this rent versus buying calculator tonight. And we kind of just, for timing purposes, just kind of pre-filled some information in here. We have a wide spectrum of geography or market locations of where we're thinking about buying, which is really cool because that's, that helps me kind of really understand where our buyers are thinking about going. I see, and just to give you an idea, obviously Florida, Alabama, Georgia, North Carolina. So a lot of the East Coast represented, New Jersey, some of the Midwest and Chicagoland. So that's a great kind of snapshot for everything. And, and we probably have some folks here in the session are looking at California too, because we do get a lot of tech alum that are out in California on the West Coast as well too. So we'll spend some time talking about first-time buyer programs as well. But let's use this $500,000 purchase price for our discussion around rent versus buying. At that price point of $500,000, you're going to learn tonight in our product segment that the minimum down payment is 3%. That means you're financing $485,000. Let's say if we plugged in an average interest rate of 6.1% today with that amount of down payment, we assumed a 30-year fixed mortgage term. And then let's make the assumption that we bought, I'll kind of change this around a little bit. Let's just say we bought in, let's just put it in March, okay? Just to kind of give ourselves a little bit of runway. All right, so if we looked at that example, we also assumed some mortgage insurance, which we're going to learn about mortgage insurance tonight, but ultimately that comes into play when we put less than 20% down to buy my house. We have homeowners insurance rates, which can vary based upon where I'm going to buy in the country. Some parts of the country have really high fire insurance, like California, for example, or maybe in our Gulf states, they're going to have elements like hurricanes, things like that that could impact what the cost of insurance looks like. Obviously, our folks down in Florida, that is one of the kind of the biggest, hurdles, if you will, in our budgets for homeownership is just the cost of insurance in Florida markets. But ultimately, we'll plug that in. We have taxes that vary based upon where I'm going to buy in the country. Homeowners association dues that come into play if I'm buying a condominium, maybe a townhouse. And then this is going to be kind of more personalized. What tax bracket am I in? How much cost am I going to pay in maintenance to just keep up my home? And then eventually I'm probably going to decide to move up and buy something else. So let's factor in some selling costs of my home. We have appreciation rates. So how much is my home going to go up each year? And then let's compare that to what my rent looks like. So in this scenario, we have someone that's paying $2,500 a month in rent. We make the assumption that they're paying some renter's insurance and that their rent will go up about 2% every year. So what our calculator does is it gives us a break-even point, which is really important. I generally would want our clients, unless they have some kind of different housing situation, I would want you to break even on a home buying investment in about 4 years or less to really kind of make the math make a lot of sense for you. But in this scenario I just provided to you, someone paying $2,500 a month, if they went out and purchased a home, they're going to break even in 3 years, meaning the cost that they have to invest versus what their recoup is in equity, appreciation, tax benefits, they're going to break even in 3 years, which is a really great example. Now, if we kind of pushed out over, let's say, 7 years, and they're kind of going along, making their mortgage payments, the market appreciation is moving by, we said 3%. Then after 7 years, my buying opportunity is $78,000 versus just continuing to pay a $2,500 rent payment and it going up 2% every year, essentially probably paying someone else's mortgage for the landlord, right? So that really is kind of the magic of homeownership. If I can look at 7 years from now, yes, I'm going to make some investments today in day one, but 7 years from now, I have a pretty good nest egg that I'm sitting in. And then after 7 years, here's what your equity position looks like. So look at that. I mean, almost $180,000 in equity position. Now, the one thing I would just caution everyone is that this does depend on where in the country you're purchasing. Some parts of the country are going to appreciate higher than others. So I think we used a pretty fair number at 3%. Real estate markets cycle, right? Generally, they're going to be an 8 to 10 year cycling period. And that's probably a good, segue into the housing market and what's happening right now, right? In most parts of the country, it's still pretty cold. In fact, I just got back from Kansas City just today, and it was surprisingly warm over the last couple of days in the Kansas City market. But as you guys know, in many of the cold weather states, it's been pretty darn cold just a week ago. I was fortunate enough not to have to experience that out in Kansas City. But when we look at the markets in general for most of the cold weather states, we're not really moving a lot right now. We're waiting until the spring buying season, which traditionally is April, May, June. Then we get into the July, August, September. Most families are trying to find a certain school district or a location to get into, maybe to have their kids in a certain district. Or maybe you're seeing job transfers a little more frequently in kind of the more of the summer and spring buying season. So that's kind of generally what we see. But I will tell you right now in 2026, in this kind of environment that we have across the country, you are seeing a little bit more buyer activity right now. I think there's a little bit of, hey, I don't want to get left behind in home ownership because if interest rates go lower, there's going to be a lot more competition out there. So I think that's kind of some of the mindset of some buyers out in the market. So, we look at even just our class signups for tonight. People really want to know what's going on in the market right now because they're thinking about maybe jumping in sooner than later. Now, one of the things we're seeing in the market, I mean, this is obviously a national look. So, prices have decreased a little bit. We're going to give you some trend analysis in just a second and some projections, but you can see, the market softened a little bit. We do have in some states like Florida, Colorado, Texas, and Georgia, we're seeing like inventory still staying on in the market a little bit longer. That's attributed to maybe lack of buyers out there, maybe some overpriced homes. Those are kind of the states with the highest amount of supply currently right now. But I do think we'll probably see some leveling out in the market right now once we kind of start getting into more of the active months, like I mentioned, the spring and summer buying season. Here's your median sales price across the country as we see it. And as we forecast out to 2026, like what are some things that we expect is going to happen based upon some of the economists that we follow and just some housing prognosticators, right? So we're probably thinking 2026 is going to be a little bit of a reset for home buying. We've been in a kind of a turbulent time of interest rates over the last 3 years, all going almost all the way up to 8%, which I'll comment on in just a second. So we've seen, the worst of the worst, I think, for now, at least in terms of interest rates. So we're looking at a little bit of a reset in 26. Price growth is going to be a bit modest, but we won't see any like massive jumps in the market. We are starting to see some of our higher cost of living markets start to reset. For example, in the California markets, like you talk about a Bay Area market, you're starting to see some prices kind of like inch down just a little bit. Not everybody wants to run out and spend $900,000 on a condo or townhouse. So I think you're starting to see some corrections there. But I think you may even see some markets start to stabilize a little bit, but also maybe some markets that don't have as plentiful buyers out there start to take a little bit of a dip. Inventory supply conditions might improve just a little bit in the market. Builders are still trying to make up the gap for what buyers don't have in supply out there. But inventory I think is still going to be a little bit of a challenge for us in today's market. I do think for those that are financially fit and ready, I think there's an opportunity to jump in the market and be able to capture some of the opportunity that exists for sellers that, maybe don't want their home on the market anymore. It's been on the market for 90 plus days, and now maybe they're a little bit more flexible in their negotiations. This is kind of the outlook for the housing market nationally for 2026 as compared to 2025. rates are going to drive a lot of this growth. Even just this little tick down that we have here. In this environment right now, economically and kind of the geopolitical environment, we just don't know where interest rates are going to go totally. But we do have some forecasting that we're looking at. Obviously, there's been an appointment and still up for Senate approval on a new Federal Reserve chair. So we're watching that really carefully. We're looking at existing home sales here to grow a bit year over year at just about 9% growth. The median home price to tick up by 0.9%, and then year-end inventory to uptick by 10.9%. So those are all encouraging signs for us as prospective buyers. Interest rate is going to influence the buyers, I think, most notably, because as I mentioned earlier, like if we look back the last 3 years, and I'll just kind of take you back here a little bit, like interest rates have kind of jumped up quite a bit, right? I say that because many buyers thinking about today's market, they ask me, "Hey, Jason, when should I jump into the market? Should I wait till rates get to 2.5%?" The reality is rates are probably never going to get to 2.5%, and hopefully they don't, because that means something massive has happened globally. So ultimately, I think when we think about the historical averages of interest rates, we're talking about low fives, maybe high fours. I'd say probably low fives, and you can see kind of our snapshot here going back to the 70s here. So as we look at the last 12 months of interest rates, we've got a nice little ride here, this downward pressure on interest rates. A little bit of an uptick here recently, but we're looking really carefully at what some of the data that's coming in. The two measurements that the Federal Reserve is looking at to see if they decide if they're going to tick down the federal funds interest rate is they're looking at what's inflation doing, as well as what's the labor markets doing. Are the labor markets struggling? Do we have a lot of unemployment? Do we have job growth? What's happening in that space? We had one report come out just on Monday showing one of the indicators in inflation was a little bit softer than expected. So that's good news for us. We also saw interest rates take a little bit of recovery. Interest rates are kind of like bouncing right back today, kind of ticking up a little bit. But ultimately, this is kind of the ups and downs of interest rates. Interest rates, so as a consumer, when you're under contract with a seller, we now can look at locking in the interest rate, because interest rates change by the minute during the trading day on Wall Street. And there is strategy to locking in the lowest interest rate. And we study markets every day, beginning at 6 a.m. all the way till the close of business of 2 p.m. when the market closes. We're making sure that we're kind of analyzing things, because some clients may have a closing time period of 30 days. Some might have a closing time period of 14 days. We want to make sure that we're strategic in trying to obtain that lowest interest rate for you. Because again, interest rates change by the minute, but also interest rates have different elements that make out really what you're going to get in terms of interest rate, or make up what's going to be in that interest rate. Things like your credit score and your eligibility on a specific product, the different program that you're going to select for home ownership, how much you decide to finance, what my down payment looks like, how much I'm going to pay to bring down my interest rate. There's a thing called discount points where you pay a certain amount of money out of pocket to bring down that interest rate. In this market, not a huge fan of doing it unless you have to from a qualifying or budget perspective, because the break-even point is about 3 to 4 years for buying down points. And then if you shrink the term down from, say, a 30-year mortgage down to 15 years, that'll generally save you a little bit of money, maybe 1/4 to 0.5% in interest rate. So I would say if you're starting to do some kind of general searching online, you're saying, hey, what is the average interest rate? And you're getting a bunch of different ads that are popping up. They're probably putting some really artificially low interest rates, or maybe not taking into consideration these elements, because most lenders, online lenders specifically, will be broadcasting 20% down interest rate options. And let's face it, as most first-time buyers, that's probably not going to be the play for us. We're not going to be able to put 20% down, but maybe it's 3% or 10%. But that change in down payment can impact the interest rate that you achieve. All right. Now, credit makes up a big part of that too, because every loan product has a minimum entry point to credit score, but also the interest rate offering that you get as a buyer has different pricing tiers based upon what your credit score looks like. So I've shared with you kind of the minimum credit scores by product on screen, but we really want to try to maximize credit score. And so in our classes like this, hopefully you'll have maybe 1 or 2 takeaways for your own personal credit score that you can put a game plan in place right away, especially as you're preparing to really take on home ownership. Now, we also, in our consultations, we do some credit coaching too. So if you're at 720 right now and we think, gosh, we could get to 760, and wow, what could that do for our credit score? Those are conversations and things that we're going to dive into as part of our session together. Now, when we think about what's impacting our credit score, major things like late payments, a lot of hard inquiries on our credit, especially in the most recent 12 to 24 months, are going to have the biggest impact to my credit score. If you've had, bigger events like maybe a bankruptcy or something, or maybe an account that was written off to a loss, that's going to have a bigger impact to the credit score. There are 3 different models to credit scoring. Tonight, I'm going to walk you through the mortgage model, but there's a credit model, and which is basically used by most institutions when they give you kind of your monitoring tools, like maybe the Discover card or Amex or whatever. There's auto financing. There's also the housing or mortgage model, which of course that's going to use when you're going to apply for home financing. They also give us a different scores. There's different agencies too to make it even more complex, right? So there's TransUnion, Experian, and Equifax. Each of those report back a different score. In lending, we're always going to take the middle credit score of all 3 agencies reporting. So if I have a 760 score as my highest score, my middle score is 740, and my lowest is 720, I don't average the scores. We're just going to take that middle score of 740, which will determine your product offering, your interest rate, all of that, right? Now, if you apply with a partner and your partner's middle score is, let's say, 720, well, that 720 score is going to drive that interest rate. So you may have to take on maybe a slightly higher interest rate or maybe more expensive mortgage insurance, because that would be now one pricing tier lower because we're going from a 740 down to a 720. All right. Let's talk about how long things are going to stay on my credit report. So I get that question a lot, like, hey, Jason, I totally missed it. One of my student loans was late. It was 3 years ago. How long is that going to stay with me? Well, a late payment's going to stay with you for 7 years, but the impact to your credit score is, again, in the most recent 12 to 24 months. Here's an example. I met with a client just a couple days ago. They have a late payment that was in March of 25. We modeled out their credit and saw that once they kind of, wait the seasoning period and get to 13 months from the date of that last payment, so get to April of 26, they actually get an organic improvement in their credit score of like 20 points. So if you've had a recent hit to your credit score because of a late payment, again, as that seasons off, you'll get that incremental lift in your credit score, assuming all of your other accounts are paid on time. This is the mortgage model for credit. And when you look at maybe your credit card score versus what we pull on your mortgage score, there's going to be some variance to that, right? Because they're looking at different things in the mortgage score than what they are looking at in the credit card score. So you may be 780 on Credit Karma, right? But then we pull our score here with mortgage, it might be 760. So here's what we look for on the mortgage score. Length of credit is the first thing. So how long have I had credit? More mature my credit file is, probably the better my credit score is going to be. How much new credit am I trying to get access to? So am I opening a bunch of new accounts in a recent period of time, especially in the most recent 6 to 12 months? Do I have lenders that are doing hard inquiries on my credit? So hard inquiries, especially in a 6 to 12 month period, are going to have a negative impact to your score. When you work with us in designing your financing options, we only start with a soft credit inquiry so you can get pre-approved for homeownership. The reason why I choose to do that is because we want to provide you a game plan for homeownership without impacting your credit score. Most lenders are going to say, hey, let's run a hard inquiry, but I don't feel that's necessary to give you some, design work and customize some options for you for a pre-approval. Next component is how much I owe on my revolving accounts. So if I'm looking at credit card debts, personal lines of credit, things like that, we're going to take those aggregate totals of balances versus those aggregate limits. Ideally, we want your balances at 10% or less of those limits, right? Now, if you're charged up a lot of accounts, maybe you're still working on paying down holiday debt, whatever the case may be, and let's say you're at 80% or $8,000 balances on $10,000 in limits. My goal would be let's kind of make some building block steps here. Let's push those credit card balances down to $5,000. That would be our first kind of like effort. Then we want to get to 30% or $3,000. And then optimal is 1,000 or less. Okay. Now I know it's easier said than done, but that's kind of where we would want to go, especially as we're preparing for home ownership. Here's my tip for you around managing revolving debt. If you look at your billing statement date on one of your credit cards, that is the date that they're going to report out to the credit agencies what your history looks like on your account, what your limits are, what your balances are. And so if you can try to pay down those balances before the end of that statement date or billing cycle date, you can catch the bureaus before they report out maybe a higher balance. So if I had $8,000 as my balance and I pushed it down to $5,000, as long as I do it before my billing cycle closes out, I can get that to report on the bureaus, push that score up, and obviously improve maybe my financing options. And we'll certainly help that, or at least give you a credit game plan as part of our home ownership consultation as well too. Last one's pretty simple, right? It's payment history. How have I paid my bills? I gave you that example of a client that had a late in March of 25. The more recent of the delinquency, most recent 12 to 24 months, the most severe it is, all the way up to 90 plus day delinquencies, the bigger impact I'm going to have to my credit score. Now, one of the things that shows up on credit reports is student loans. I get a lot of questions around this. In fact, I was texting one of our clients about that just this week. Is that how is that going to impact me in my qualifying? I do oftentimes get attendees to our classes and say, hey, Jason, I can't purchase a home. I got too much student loan debt. I can't do it. Well, that's kind of a misconception, I would say, because the way we look at student loan debt is if you're in a savings plan right now or an IBR payment, we can still use that minimum payment for qualifying for your loan, but you have to be in active repayment. So if you have $75,000 in debt and you're paying $250 per month on a savings plan, we can use the $250 payment right away for qualifying. Where it can get a little tricky is that if you're not in repayment, maybe you're back working, working on your master's program, or maybe you're just still in forbearance, whatever the case may be. If you're applying for a mortgage and you don't have an active repayment, then by product, we have to assess a minimum percentage of balance as the monthly payment. So as you can see on screen, you do an FHA loan, 0.5% of the balances will be your monthly payment. You do a conventional loan, it's 1%. So that can really influence the qualifying. We're going to help walk you through that during our consultative process, but I don't look at student loans as a hurdle in homeownership. We just got to basically understand them a little bit better. All right. Now, the reason why we look at student loans is because each loan program has set guidelines that we have to underwrite to and make sure that a client is going to qualify in that particular product. And every product's going to have an analysis that we have to do on student loans. And that's why I want to kind of share that with our group. This is some of the terminology that you've probably heard, and if you've already started discovering homeownership or searching online. The first product is a conventional loan. That's a Fannie Mae and Freddie Mac loan. For first-time buyers, minimum down payment's 3%. There really is not, Fannie Mae is not requiring a minimum credit score now, but they do have an overall risk assessment. So the higher your credit score is, the better chance you're going to have qualifying in the Fannie Mae loan. The maximum loan amount is $832,750, but that is what we call the conforming loan limit. I think most of us in class today, except for maybe some of us on the East Coast, are not in what we call high cost of living areas, because high cost of living areas will actually allow us to stretch that loan amount all the way up to like almost $1.2 million. But the minimum down payment jumps from 3% to 5% if we cross over that maximum loan amount there, right? The next product is the FHA loan. That stands for the Federal Housing Administration. That is a government insured loan. You can see the minimum down payment, a little bit lower credit score requirement than conventional. And there's a maximum loan amount that gets set by the county. Now, this isn't a government insured loan. So I do like to point out to our classes that unfortunately, the administration has made some changes with eligibility around citizenship. So you do have to be a permanent resident to access both the FHA product and the USDA product. Otherwise, if you're not a permanent resident, you can still get access to the conventional product, just not on the government insured product. USDA, since we're kind of speaking on that topic here, is a government insured product, but it's designed to help clients that want to purchase in more rural areas. The benefit around that product is it's 100% financing, but there is some guidelines to that require you have to, like, for example, you have to be in a certain USDA designated area, and there's a maximum loan amount, income amount based upon your household size. All right. And then the jumbo loan product's not something that we're probably going to dive into as first-time buyers, but it's more kind of be that next step purchase. But it really allows buyers to purchase that, at loan amounts that exceed, say, the Fannie Mae loan limits in your respective markets. And then a VA loan is obviously for a veteran that has access to the VA home loan product. There's a zero down payment option, which most veterans elect that option, and then minimum credit score. You can see this VA product has a lot more flexibility with qualifying and maximum loan amounts, just to encourage homeownership for our veterans that have served, right? So that's kind of a quick little 10,000 foot view at products. So you may have heard some of that terminology, but hopefully, like I said, hopefully that kind of puts the pieces to the puzzle a little bit for you. One of my hot topics that comes up quite often for our clients is around private mortgage insurance, or PMI. I want to explain both to you PMI but I also want to explain to you government insured insurance under FHA. Before I do that, let me answer one of the quick questions that came in, which is, are these loan programs still applicable for multi-unit properties for first-time buyers? So yes, to a certain extent. So most first-time buyer assistance programs will not allow multi-unit properties. Okay, so that's one. Two is when you buy a multi-unit property, so something more than a one-unit property, so anything from 2 to 4 units, on a conventional loan, the minimum down payment is 5%. On an FHA loan, the minimum down payment still stays at 3.5%. Okay. Now, that assumes that you're going to occupy at least one of the units as your primary residence. If you're going to go out and say, hey, I want to build my real estate empire day one, and I want to buy a 4-unit property, conventional financing, then you're going to have to put 20% down for that level of units for a property. Okay. All right. So PMI, let's kind of talk about that. Big misconceptions around PMI. There probably isn't a day that goes by that I'm not talking about PMI with clients, but PMI is broken down by what, or based upon, I should say, by what my down payment is, my credit score, and how much I finance. The higher I can get credit score, the higher I can get my down payment. I'm going to probably improve the cost of my mortgage insurance. If you started doing some research on Zillow or Redfin, whatever platform you're doing home searching on, if you're using their calculators, they're probably not super accurate because they don't have them calibrated to those elements. PMI on a conventional loan specifically has a cancellation option that when I have 2 years in the home elapsed and 20 to 22% equity, I can apply to have mortgage insurance canceled. And that's one of the big draws to the conventional product. Also, as you can see down here in our PMI example, the cost of PMI with a 3% down option for a 740 credit customer is 138, 138.75. Now, that could look even maybe lower if I was at a 760 or a 780 credit score, or if I'm putting more money down, right? So if you're doing some calculations online with some different tools, that might not be as accurate as what I have on screen. Those calculators that I showed you guys earlier this evening, those are really helpful to help kind of build out some accuracy with your payments and the elements like mortgage insurance. FHA, a little bit different. So FHA has both monthly cost at 0.55% of my total loan amount and an upfront mortgage insurance cost, which is 1.75%. So mortgage insurance on an FHA, while it doesn't have the elements that can make it cheaper, they are fixed, but it's a lot higher in cost. The reason for that is FHA has a little bit more flexibility in the underwriting guidelines, minimum credit scores as such, more flexibility with expenses versus income. Now with FHA though, it can only be canceled through a refinance, maybe out of FHA into a conventional loan. So you don't have that cancellation option like you do on a conventional loan. Here's the expenses of mortgage insurance. You can see there's upfront mortgage insurance costs. There's also the monthly costs. So ultimately, FHA will be a little bit more expensive than a conventional loan. The other thing I just want to point out to you, as we think about interest rates, FHA, especially if you're doing some online searches, you'll see FHA rates that are maybe 0.5% lower than conventional. What you probably didn't know until you attended tonight's class is that when you look at the expenses involved with FHA, it really doesn't make that lower rate make as much sense. So if you're a qualified conventional buyer, you really wouldn't want to go to an FHA product because now you're going to create layers of expenses that you really don't need if you're eligible for conventional financing. All right. Let's talk a little bit about income for qualifying for a mortgage. I'd like to just kind of go through some different scenarios with our class because I get a lot of questions around, hey, Jason, can I use my income because I just started my job? Or, hey, I have some variable income. What does that look like? So we'll go through some different scenarios that typically come up in my conversations with clients. But I also wanted to share with you some documentation. As you're starting this journey with us towards homeownership, if you're looking to do a consultation, thought I would pass along some of the typical documents that we would ask for in the process. Usually it's a 2-year history of most items like W-2s and or 2 months of bank statements, and then 60 days worth of pay stubs. So let's talk a little bit about income and what kind of makes up eligible income. Now we do have to take a record of 2 years of work or educational history. So if I just graduated from tech, in the winter semester, right? And now I'm just starting my job, just new this year. I've only been on my job for a couple months. I can still potentially qualify for a mortgage as long as I can piece together my education history and my new job. So that is still an opportunity for homeownership. So, if you look online, you might think, hey, I have to be on my job for 2 years before I can apply for a mortgage, but really not the case. So we just have to make up a 2-year history of work or education. Now, if I'm self-employed and I've just opened a business and maybe I've only had that job opened that business for about a year and a half, that might be a little bit more challenging because we have to verify that a self-employed individual has filed 2 years consecutively of taxes so we can do a full income analysis for them. If I'm in a job that has a base salary, but there's also like a commission or a quarterly bonus component, whatever the case may be, if I want to count that variable source of income, then like the bonuses, for example, then I have to show that I've been on that job for 2 years because we'll average bonuses over that 2-year period. If I'm in an hourly job and I work 40 hours a week, but I also work a lot of overtime, if I want my overtime counted towards my mortgage, that's also a situation that we have to show that we've been on that job for 2 years. Okay. So hopefully that helps a little bit. I also get questions around dual employment. So we have some of our clients in the healthcare industry that, is working for multiple clinics and want to count both sources of income. In that case, I have to show that I've been on both jobs simultaneously for the last 2 years. Sometimes we have that also with traveling nurses that work from different locations. As long as we can show that that nurse has been in the field for 2 years and working at multiple locations, that could be eligible for financing. We just have to average the income over the past 2 years. If I have Uber income or Lyft income, but I have a 40-hour work week job, if I do want to count that other source of income from Uber or Lyft, then I just have to show that I've been on both jobs simultaneously for 2 years. All right. If you guys have any questions about scenarios that you want to run by me, go ahead, feel free to drop those in the chat or Q&A. I'll run some of those by the entire class. But those are some of the things that typically come up. One other thing I just want to mention in class is that we'll also have scenarios where maybe a partner is contributing to the household expenses, but they choose not to be on the financing for whatever reason. Unfortunately, we can't count that stream of income that they're contributing unless they decide they want to be a part of the financing. Okay. Now, one of the things we look at, let me just back up for a second. I kind of jumped ahead a little bit. One of the things we look at is income generated versus expenses. And that's one of the qualifying parameters around what we call debt to income ratio. Ultimately, we're looking at is your pre-tax income if you're a W-2 employee versus your expenses that you're going to have, including the new expenses of like the home budget that you're going to have, right? The principal and interest of my loan, property taxes, homeowners insurance. Maybe I'm buying a condo and I have some HOA fees. All those get kind of baked into my monthly payment along with my existing expenses like student loans, credit cards, car loans, right? We generally don't want those expenses to be more than 45 to as high as 50% of that pre-tax income. So that's what we call the debt to income ratio. Ideally, or the comfort zone for most first-time buyers is going to be 36% expenses to income ratio or less. That's what we've found in hundreds of classes and consultations that we've done is really the most effective as kind of the sweet spot for most first-time home buyers. I've provided the calculation for you in expenses versus income or debt to income ratio. You can see kind of a real life example here. But again, we're looking at existing expenses versus what your projected housing expenses look like. And so debt to income ratio is an important element to qualifying. It can at times impact your mortgage insurance costs as well too. Last component to homeownership as we're thinking about preparing for homeownership is down payment. I'll be honest with you guys, this is probably the biggest challenge for most first-time buyers is just saving up enough in reserves to make the mark for what my down payment needs to be, whether it's at 3% or 5% or 10%, as well as what I need for closing costs. Now, closing costs to purchase a home in most parts of the country is 2 to 3% of your sales price. That's what generally kind of we bake into that calculation. Now, what can I use to pay for those down payment and closing costs? Well, checking and savings accounts can be used. Just can't use cash accounts or cash deposits, I should say. Retirement accounts, 401ks, 403bs, investment accounts, brokerage accounts, those can all be used for qualifying. You can even get gift funds from family members that are willing to help out for your home purchase. So that's completely allowed around home ownership. There is no seasoning requirement to gift funds, but there is a process to the delivery of those funds. All assets outside of gift funds that are used for the home purchase have to be seasoned for at least 60 days. Okay. I did get a question, is the class being recorded? Absolutely. Our class is recorded and the slides are being shared tomorrow morning. So that'll be all up on our YouTube channel for you guys to check out. Okay. So yeah, sorry you're able to get here late, but I'm glad you joined. Now let's talk about kind of as we're preparing for home ownership, there's kind of approach that we like to coach clients on. It's really just a savings plan approach. And in fact, we've had several clients go through this exercise. It's really simple, but it kind of just sets you up for a little bit more success in meeting your savings goals. So let's say, for example, you're spending $1,500 a month right now on a place in Georgia, right? And you're renting a place, you got a one bedroom apartment for $1,500 a month, but you do feel like with your new job, you got a good stable income. When you make that leap into home ownership, you can afford $3,000 a month, right? So it's going to be a big jump. It's going to double my housing expense, but right now, how can I start saving like I'm making that $3,000 mortgage payment? So here's what I would encourage you to do. First of the month comes, you pay your landlord the monthly payment or rental payment, right? We create that discipline or habit that we take another $1,500 and we automatically transfer that to our savings account, right? We do that for 6 months. We got $9,000 that builds up. In 12 months, we got $18,000 that built up. That's a really good start to preparing for homeownership. We might not even need that much money after we implement assistance programs and whatnot, but a great way to prepare you for homeownership. I had several clients that have just implemented that really simple like adjustment to their budget, and it's really got them in a great position for homeownership. So I'd encourage you guys to check out something like that. I did get a question around assets in the Q&A, which is, what do you mean by seasoned assets? So ultimately in seasoned assets, we're talking about something that has seasoned 60 days. So, for example, let's say I just picked up $20,000 in cash that I had at home, right? I just put it in my account, but I want to run out and buy a house right now, right? Well, those assets have only been in my account for a couple days. So those would not be seasoned assets. So I couldn't use those for home ownership. But if I had my paycheck just went in on Friday, I got paid $3,000 net paycheck, those have a source that we can use, right? We have a paper trail right there, but the cash doesn't. So that would not be seasoned funds. Now, if that cash sits in there for 60 days and seasons out, then we're okay to use it. But we're gonna have to wait 2 months to be able to use those funds. Okay, hopefully that answers your question for you. So let's talk about assistance programs. And I know we have, most of us are going to be kind of, Midwest and east of the country. So I want to share with you a few programs that are available out there to you. There's a variety of different programs we offer. One is the Freddie Mac Borrow Smart program, but that is designed for more low-income housing buyers. It provides a little bit of support. It's like $500 to $1,000 in grant, but you have to make less than 80% of the median income. Within APM, we also offer a 1% program. We don't have it here on slide, but what it essentially means is if you're going to do a 3% down conventional loan, if you contribute 1% towards your home purchase, we'll contribute the other 2% to make up your 3%. It is a grant that you would receive from us. That's a great product, but you do have to make less than 80% of the median income. There are some limitations on loan amount as well, too. We also offer the Pathway DPA program. Now, it's only available for FHA loans, but is a national program. There are no income limits, which generally is really appealing for a lot of our clients, which provides anywhere between 3.5% to 5% of your sales price in assistance. The state of Georgia does offer the Dream Homeownership program that can provide up to $10,000 to $15,000 in assistance. So that is an option. Those of you in Florida, we do have a Florida first-time homebuyer option. There's options in North Carolina, Chicagoland area has options. I will tell you, most first-time buyer programs, you're going to have to make, somewhere between 80% or less of median income, as high as up to 120% of median income or less. California, as we have on screen here, is an anomaly. They do go up to 150% of median income or less. But generally, most first-time buyer programs are going to have some type of element of assistance towards down payment and closing costs. They might have a grant option for you where you don't have to repay it if you stay in the property a certain amount of time. Or it may just be a low interest rate loan that they provide you for the amount of the assistance. So there's a wide kind of spectrum of assistance options. If you have a specific product that you've seen out there that you want to review with me, I'm more than happy to do that. But as part of our consultative process, we're going to dive into specific programs and show you kind of how they could help better support you, or just make sure that if you're eligible for those programs, what they can do for you as a resource. So typically, like if you looked at a $450,000 purchase price, for example, right, and you were putting 3% down, and you also have to factor in those closing costs, you would probably need about $22,000 to $27,000 to buy your home, right? For some of us, that's going to be a 2 or 3 year goal for us, right? Even with implementing our savings plan. But when we factor an assistance program, for example, let's say we use the California-based program. There's a program called My Home Assistance that provides 3% of the purchase price in assistance. So it basically offset what I have to contribute out of pocket for down payment. but then there's other products like My Access that would help with closing costs, for example. So there's ways that we can construct first-time buyer programs. I would say first-time buyer programs don't get talked a lot about, especially online, because many lenders aren't approved for those programs. So when you go to the big bank, for example, to say, hey, I want to purchase my home, they're probably not going to, provide you the options around first-time buyer programs because most of them are not set up for that. But, that's one of our specialties we do when you have classes like this and we're teaching local community education on homeownership. We also want to make sure you have some tools in your tool belt as well too. So first-time buyer programs can be a great way there. Last topic for tonight's class is the buying process. And I think it's a really important way to kind of tie this all together for you. Like, where do I go from here? This is our really simple 6-step visual aid to homeownership. After tonight's class, I'd love to be able to get connected with you for a free consultation. And that doesn't have to be something where you're looking at buying a house this weekend or maybe even not this year. I just want to help put the framework together for you with homeownership. Now, the output of a free consultation with us, and by the way, that session is a 30-minute virtual session, but the output of that consultation is to be pre-approved. Now, you don't have to go around and buy a house this weekend, but you get some basic numbers for what your pre-approval and eligibility looks like. A pre-approval can be extended or recertified at any time. Your application stays live with us for 2 whole years, and we only do a soft credit check. So there's really no reason why you wouldn't want to do a consultation just to learn like what could it be for you, because you're not really having a commitment. It's just really getting to understand how you can have your customized options available to you. Now, as you move forward in the process, it gets a little bit more exciting, right? Because now you're doing some house hunting. You know what you qualify for. Now, what does it look like in my local markets that I want to buy in? I would encourage you to talk with a realtor in your local markets, someone that you trust. We do have a preferred network of realtors that we trust, and we can make an introduction at some point if you want us to get you connected with someone that's a resource for you. Now, house hunting probably starts online, then eventually moves to, hey, I'm taking a Saturday afternoon, I'm gonna go look at 8 homes, right? And so that'll happen in step 2. If you identify a home that you like, you want to place an offer on that property, the realtor is going to help build that offer for you and then ultimately present that to the selling agent for that property. It might take 2 or 3 times before you get an accepted offer, right? You may have the idea that, hey, I'm going to find that right house, I'm going to place an offer, and the offer is just going to get accepted, right? Doesn't always happen that way, especially in some of our hyper competitive markets, but let's say that offer does get accepted, right? That will then move you to step 3. And in different parts of the country, it's called different things, but it's called entering escrow. Now, when that offer gets accepted, then you're going to have a timeline of closing escrow on your home. It could be 30 days, it could be 60 days. You may be buying a new home and it's taking 6 months to build a home, so it might take longer. Our shortest closing time across the country is 14 days. That's really fast. It's lightning speed. Not always great for first-time buyers, but some markets that are a little more competitive, we do have to do that. Now, when that offer gets accepted, I'm going to give you a call as soon as I get noticed of that acceptance. Say, hey, congratulations, you did it. Your offer is accepted. Let's walk you through some next steps. Let's schedule you for your follow-up virtual session so we can kind of go through the fine-tuning of your financing. Let's talk about interest rate strategy, what products we're going to elect, all that fun stuff, because we've reviewed it during step 1 at pre-approval, but now we kind of want to fine-tune everything a little bit. Now, you're going to start getting disclosures in the process. You'll have some action items on your side, like making a deposit on your house. Most parts of the country, it's a 1 to 2% of purchase price amount that you'll be placing into escrow. Those funds are held, but they do count towards your total out-of-pocket expense. Most real estate contracts do have what we call as a contingency that protects that amount of money. Because as a buyer, you're going to have to do some investigative research on this property. So your offer has been accepted, great, but let's learn a little bit more about what the inspections turn up on your property. Let's learn about what the house value looks like through an appraisal. Let's get your loan approved through our lending underwriting department, right? All those important things happen as part of the escrow process. You can see kind of at a high level that escrow is going to run from step 3 to step 6, right? So we're doing all these things inside of that kind of block of time. Things like administrative tasks, verifying your employment, the assets you're going to use for the transaction. Maybe we're putting together the gift letter that your uncle is going to provide $15,000 towards the closing, all that kind of stuff, right? We're also, again, keep on talking and managing what's happening in the interest rate market so we can try to secure the best option for you, right? Now, as we continue to the next milestone is loan approval. There is an automated approval process that happens, as well as an underwriter physically looks at your income assets, your program type, just make sure everything kind of checks the boxes, and then issues a loan approval. Throughout this lending process, you're going to be getting disclosures sent to you're going to be getting push notifications on status changes on your application, all done through mobile or desktop, whatever platform you elect, or multiple platforms. Then we get to step 6 in the closing process, and that takes us to the very end of the buying process. Now, prior to us getting to this big day, you're going to get a final closing disclosure that gives you a 3-day cooling off period before we get here. Step 6 is the last milestone in the process, but it's also an in-person process. Everything prior to that's all virtual or e-signature. On that day, you'll be signing documents with an attorney, an escrow officer, maybe a public notary, depending on what respective state you're buying in. And then that same day, you'll also wire in the final funds for the closing of the home process. Some states, we call it table funding, where you'll sign the same day, we'll close the same day. Some states, you sign one day, we close the next day. It just depends on what location in the country you're buying in. But once we close escrow, that means you become the official owner of the property. That's a big day because, hey, guess what? You're going to fire up the moving truck, get moved in. We're going to call you and say, congratulations, send you a housewarming gift because we want to celebrate along with you. But, our relationship doesn't stop with our clients there. There isn't a day that goes by that we're not talking to our clients about what's happening in the market with maybe refinancing opportunities, maybe just talking about strategy on maybe I get a home equity loan because I want to, put a pool in my backyard. All of those things are part of our client relationship that spans over years. Clients that bought in 2023 are calling us and saying, hey, Jason, I heard rates went lower. What do you think? So those are things that were happening. But ultimately, that's kind of what the buying process looks like. So going from classroom setting like this, getting pre-approved, finding your home of your dreams, going through the escrow process, and then ultimately getting your keys and moving in, right? So exciting times for all of our buyers. Now, if you're thinking about moving forward in the process, we'd love to have you connect with me for a free consultation. Again, not really a lot to getting prepared for that consultation other than getting your online application submitted, uploading some really simple documents. We're only doing a soft credit check, and then I'll meet with you in a virtual setting for 30 minutes to really just design a home buying plan for you. Now, you might have some questions after tonight's class that you're like, hey, you have a scenario, I had some credit situation going on, or maybe I want to learn more about, the Georgia Dream program or whatever, product that you're thinking about. You want to just kind of talk through it with me. Schedule an introductory call. That's a great way for me to kind of learn a little bit more and help see how I can best help you. This is our consultation service. So it's different than what most lenders do. Most lenders are going to say, hey, go in our portal, put an application in. Do I qualify or not? We look at the buying process as much more of a high-touch experience. The foundation is education, and then we launch into all the elements of home buying. And I think that's one of the big differentiators for us in today's marketplace. We embrace technology as well. We do things on mobile. We embrace AI through some of our tools that you'll be able to use as a client. But ultimately, again, it doesn't replace the high-touch experience. Let's face it, again, this is going to be the biggest purchase that our class decides to make at some point in time. So we want to make sure we're there as a partner through the journey. ChatGPT can only teach us so many things around home ownership. There is a really human element to home ownership that really is an important piece of getting to kind of the finish line with home ownership, and obviously having the right product along the way. Part of our partnership with our tech alumni is we actually discount our services for you, try to provide you the best financing option available for you in your community. Of course, you have the access to these classes like we're teaching tonight. And we consider ourselves a trusted resource for you. In addition to our partnership, which we love, is we have other partnerships span across the country. So again, as I mentioned earlier in class, if you have friends, family, or coworkers that want to get connected with us for one of our classes like this in their local community, they can check out some of the upcoming classes at mortgageeducate.com. We're going to wrap up tonight's class. And before I do that, I thought I would share with you one of your own fellow alum that was just absolutely a pleasure to work with. Just late last year in the fourth quarter, Hannah and Jesse purchased just outside of Atlanta. And I wanted to kind of share with you like kind of their testimonial, because this is what it's all about for us, really. We kind of just go from this setting here and then just being able to make homeownership dreams come true. And I just want to highlight a few things what Hannah and Jesse said about us. He answered all of our questions, explained the home buying process simply and effectively. He streamlined the necessary financial information, significantly reduced our financial stress. He works seamlessly with the realtor because it is a partnership. And the last thing I just wanted to share with you is that, Jason made home buying effortless and efficient as possible, even streamlined closing compared to what, other friends and family have heard and their experiences. So, that's what it's all about for us, making home ownership happen with ease and convenience, because we understand you guys got a lot on your plates. This is a high stress type of situation, right? So we want you to kind of lean into the experts to help you get to the finish line. Here's all my contact information. So if you do have some questions after tonight's class, again, you can do an introductory call or just reach out to me with a simple email. And we love, in addition to the testimonials, like Hannah and Jesse, your own fellow alum that's talking about us, we love what our community says about us on our social channels, whether that's on a Reddit community, whether it's on some of our Google reviews. We want to share with you, we really put up with what we're saying in our classes. We deliver our promises to our clients. Okay. So that's what we have for you tonight. I know I got some questions kind of stacking up here for me. So we do have a few minutes left in tonight's class, but we'll stick around for any other questions. I do appreciate you being a part of tonight's class. Hopefully you had one or two takeaways that can help you in this major financial decision. So let's dive into some questions here, which the first one was, do you have any thoughts on getting sellers to cover closing costs, potentially through higher asking prices? Yeah, I mean, that's a big one. In fact, I was working on that with a buyer just a little while ago, which what we're talking about here with that question is, if that house is listed at say 450 and you're like, hey, I'd like to try to negotiate them either to stay at that listing price and cover all closing costs, that 2 to 3%, or maybe, I might need to go to 460. The seller still gets maybe their net return that they're looking for, but they're going to credit me back $10,000 in closing cost credits. That is definitely a strategy that's used, especially in high markets that, let's face it, have some inventory that's stacking up a little bit. Now, the rule as a lender is that if you're putting 10% or less down, the maximum seller credit you can receive is 3% of the purchase price. If you're putting more than 10% down, you can get up to 6% in seller credit of the purchase price. On a conventional loan, on an FHA loan, it's a maximum of 6% straight up, regardless of what your down payment is. Okay. But yeah, that's definitely a strategy. We can go a little deeper in that if our class wants to, which is like you can do 2-1 buy downs where you can have the seller that is going to take a credit and help you decrease your interest rate in the first 2 years of your mortgage. We call that 2-1 buy downs. So if let's say today's starting rate of a 30-year fixed mortgage is 6%, year one, you could have a 4% rate. Year two, you would have a 5% rate. And then year three and beyond, you would have a 6% rate for the duration of the loan. The strategy there is in a lower trending interest rate environment is that if I can get a 4% and 5% rate in year one and year two, hopefully I can refinance to a similar rate at 5% and at least obviously save myself a little bit of money in the first couple of years. Okay, so that's definitely a strategy that works. I will say in our testimony that you had here, like in some of our Georgia markets right now, we are seeing many of those transactions coming in through with seller credits. So in markets where you have a little bit more inventory, you are seeing a little bit more kind of flexibility with sellers. And then another question was, would it make sense for us to operate together if I'm very far away in Washington State? Yes, it could make sense. Yeah, I work all over the country. That's why we're a nationwide lender. But in today's environment, clients don't go to brick and mortar offices. They usually do things virtually online, but I meet with every client that I work with. So all of our clients that we support through our workshop network is all done one-on-one with me. So yeah, hopefully, yeah, it could make sense for us to work together. We'd love to be able to help you. All right. Thanks for those questions, guys. What other questions do we have in class? Okay, got that. Okay. I know a lot of you are still sticking around, see what your classmates ask. So let me see if there's anything else that's come in. So, okay, cool. Okay, got that. Okay, I think we're good on questions, everyone. Again, we'll have 3 other classes this year. This, of course, class is recorded, but if you want to do a refresh, because let's face it, the market is changing quite often. So if you want to just get back connected with us, again, all the classes, we don't have the dates for the next 3 classes. We'll be working on that with Alumni, but you can find those at mortgageeducate.com. And then for our tech alumni, you do have a landing page that highlights some of those discounts that I mentioned again. One other thing, actually, we got a few questions that just popped in as I'm kind of wrapping up, but let's answer these. A lot of attention was spent on low deposits. What if we put over 20% down? If you can put 20% down, that's great. And that's an anomaly for most first-time buyers. But hey, if you've got to that position of 20% down, obviously you eliminate the need for mortgage insurance. You're probably going to be able to optimize interest rates. You're more than likely going to do a conventional loan. So that's great news. And yeah, whether you're putting 3% down or 50% down, I mean, we'll figure out the right product to get you connected with. Do credit freezes prevent you from doing the soft credit check? Yes. So on a soft credit check, we generally use Equifax. So you would want to unlock that bureau, and then that allows us to do the soft credit check. But the benefit around doing a soft credit check, it does not impact your credit score at all. Okay, so you guys don't have to worry about that at all. And that's really important because I will tell you, most first-time buyers that I work with coming out of a class like this, like they're not looking to run out and buy a house tomorrow. It's really building the framework for homeownership. Now, they might, but I don't want to impact your credit score if you're whether you're going to buy tomorrow or you're going to buy 2 or 3 years from now. I think you can get the information you need without having to do that. And then I think, okay, yeah. The class is being recorded. So yeah, so sorry that you got your times wrong, but yeah, everything I just went through for the last hour, it's all recorded. That'll be up on YouTube tomorrow, as well as all the slides are being sent to all the guests who signed up today. Okay. All right, we did it. Well, I appreciate you being part of tonight's class. We had a really well-attended class. I do hope I get a chance to connect with all of you and just be a partner for you around home ownership. I hope you guys have a great rest of the week and look forward to seeing you all soon. Talk to you soon. Have a great night.